Today, we're going to talk about 5 tips that I've learned over 30 years of investing on how to invest like pros. Many of you know that I've acquired over $3 billion in assets over a 30-year period. So these are some of the tips and the 5 top things that I believe are the most important if you're trying to fine-tune your strategy moving forward. So the very first tip, of course, is set a goal and make a plan. And I talk about this in my book on page 20, The ABCs of Real Estate Investing, which I wrote over 20 years ago. For many of you, I know that you do not have a plan for your life financially. I personally and my company has a 1, 3, 5, and a 10-year plan for investing in a strategy so everyone here can get behind that strategy. This is not optional. This is a very important step. However, while it might seem completely overwhelming, I'm going to help you walk through this step by step. The best strategy I've seen, and which I wrote about in my book, is the SMART method, which is specific, meaningful, actionable, realistic, and of course, a timetable or timely. Find what it is you want to do and just follow this strategy, and trust me, everything will start to open up and you'll start to figure things out as you go. When I started my real estate journey, I started with one small acquisition, which was a 2-bedroom, 2-bath, just like this house. And eventually, I moved to apartment buildings later. Each one of those required me to set a goal and a plan because these two things are very different, even though they're all in the real estate category. So for some of you who are just beginning, be very specific. I want to buy one single family house in the first year, and I want to have $200 of passive income. That's very specific. Now, what you don't know, of course, is how to do it, what market to get into, and all that stuff, but that comes later. But you have to start with something that has a target. So inside of these goals are what we call milestones, and we're not going to talk about those today, but those are goals inside of these goals. And all you need is to start with one, and then when you do that, you'll see that this is not as hard as you think. Then you can move to the larger stuff, where you can buy 100, 200, and 300 unit properties. And you just don't have to buy real estate this way. You can buy businesses, you can buy industrial, you can buy billboards, you can do all these kinds of things, which we're going to talk about later. Number 2, and probably the most important one that I can't stress enough to you, is stick to investments that you understand. I am here to tell you that I've lost so much money investing in things that I did not understand, did not even know what question to ask. That could be single family, it could be apartments, it could be land, gold and silver, billboards, or even Wall Street, where stocks and bonds and all those kinds of things. These were all super confusing, even to me, when I first started in the business. But this is a slow process, and as you move through these things, you're going to learn more and more. And the best part about all of this is that there are lots of experts in all of these categories, so you can minimize your mistakes as you invest, or you turn your money over to somebody that you're going to invest with. In today's environment, you're better off sticking your money in 1 or 3 month or 1 year treasury bills at over 5% than investing in these categories if you do not understand them. If you were like me in the beginning, this can seem super overwhelming, but I can tell you, you're in good company. Most people do not understand how to invest in all of these things. I can assure you that if you start to understand these things, you too will develop your path to financial freedom. 3, diversify your market selection. Now, I learned this the hard way. So I've seen many people, for example, invest in one thing or one city, like people put all their money into stocks, or people put all their money into Bitcoin, or people put all their money into single family houses, let's say into a certain market. So I don't particularly care what you invest in. What I'm suggesting is that you diversify. So all good money managers have diversifications. They have money in stocks, they have money in bonds, they have money in cash, they have money in gold and silver. They even have diamonds, and they have real estate, and they have all those kinds of things, and they're looking at the whole allocation. In this particular case, for real estate investors, I want you to diversify in your market selection. I picked this particular graphic because the majority of people that watch my channel are millennials. These are the 10 best U.S. cities for millennials. Now, why wouldn't you want to invest where the people that you hang out with are going the most? But there's so many graphs like this. If you're investing in senior housing, this would be a different graph. If you're investing in student housing, this would be a different graph. And the point is, you want to diversify in different markets because different markets will perform differently at different times. Obviously, what you want is for all markets to go up at the same time at the same rate. but they're not going to. You're going to have some markets that lag and other markets that are going to do really well. And what you want is to balance out the average. So whether you're diversifying your market or you're diversifying your portfolio, diversification is super important for whatever your strategy is going to be moving forward. 4, roadmap your investment strategy. Now, this is probably the hardest part, but it's really important that you understand where all your cash is going and why. So as you can see on this graphic, I've labeled these 1 through 9, starting with saving tax. Now, why would I start with that? This is the most underlooked way for you to save money, is to save on tax. Tax is the #1 expense of your life. So why wouldn't you look for things that could minimize legally that expense against what it is you make? Most of the professional investors and most of my friends are always looking for ways to save tax. So if you guys have questions and you're part of our inner circle, I'm happy to answer more questions about this graph as you move through here. But obviously, you guys are trying to keep as much as you make and make sure that's invested well and it's there when you retire. There's lots and lots of ways to roadmap your investment strategy, and these can change as you get married, have kids, and those kinds of things. It's very important that you understand your strategy for when you go in to meet with whoever you're going into, and they are a piece of your strategy, and they're not telling you what they think your strategy should be. 5th and final thing, which you guys hear me talk about a lot, is the difference between cash flow and capital gain. And this is starting to show up right now because many investors that have invested over the last several years have lost that capital gain as these values have gone down, and they don't have any kind of cash flow to hold on to the asset. So one of the biggest stories going right now, of course, is Airbnbs. So many people bought these Airbnbs with these big revenue projections, trying to run these properties like a business or like a mini hotel. What has happened in many cases, that strategy isn't working, and they don't have the cash flow to fall back on. And therefore, they're losing the properties. The same thing is true for any kind of real estate that you buy, hoping that it goes up. Now, there's nothing wrong with having a capital gain strategy, but when it's your sole strategy, it's a problem. What you're really looking for is a cash flow strategy and a capital gain strategy. And in many cases, you can have both. And you should only buy assets that actually have both. Because I've been in situations before where I bought properties, the values have gone down, and what saved my butt in all cases is my cash flow, is the tenants in there already cover the regular expenses, and therefore I just had to hold and wait until the capital gain came back again. This is exactly what you're starting to see in a lot of the commercial real estate that I've been talking about, like office buildings and multifamily, and certainly in many cases in the single family arena as well. So if you always focus on cash flow, you can capitalize on the capital gain strategy when the market's hot, but when the market turns and it goes down, you can rely on the cash flow to keep that property during the rougher times.